Hi there, it's showtime, 7 o'clock, and as promised, this is the first live stream I'm doing. Hi there again. It's about finding promising dividend stocks. It's the subject which matters to most investors, to most long-term investors. And I think if dividends did not exist, then stocks wouldn't be so interesting for many people. I will introduce myself first, but maybe just for me, nice to know, is somebody here? Post a comment, please, so that I know that I'm not talking to myself, basically. I'm still waiting for the first comment, at least. Okay, I will just introduce myself. So I'm speaking to you from Germany. I'm an investor myself. I am the founder of Dividend Stocks Cash. It's a stock screener to help you finding promising stocks for your long-term investments. The screener exists in, there are some people here. For sure, German names mostly, okay. That's because I am the most popular in Germany, where the screener appeared first on a German website called Aktienfinder.net. I also have 2 YouTube channels, an English one and a German one. The German one is rather popular with more than 20,000 subscribers. The English one is much less popular with several hundred subscribers, and I'm not doing so much marketing till now for the English website. And the screener itself has more than 30,000 members, which is, I think, rather impressive for mostly a one-man show. And I think that it speaks for itself. And this is a try to give you a little bit an introduction to help you. And of course, we will use the screener on the one hand. On the other hand, everything I say is general knowledge. So it doesn't matter if you use a screener or not. It will help you to get a better idea of how to find promising dividend stocks for your investments. Okay. Okay, there are 2 people here at least. So maybe we already start the deep dive. If you have any questions, any comments, feel free to ask. I am happy if this is not, as I remember, it was mostly in school. There's one person speaking, it's a teacher, and the other people are either sleeping or playing with each other. I don't know what they did. I was also not the best pupil, so I know how you might feel maybe. So feel free to ask anytime. I see all your comments here on the right. Maybe my face is not that interesting to you. The real stuff happens here on the web. Some words or to get better in touch with you. So what do you think if you are searching for promising dividend stocks? What are the most important aspects? I'm waiting for your answer. We will see if an answer is coming. What's the most important? What do you need to focus on if you are searching for promising dividend stocks? What's the most important aspect? Okay, as I see you're still a little bit shy. Okay, I will tell you, it's not dividends, it's profit. It's the company's profit, because without company's profit, there will be no dividends. Some cases exist where there exist dividends, but no profit of the company. And this is, you might guess, not sustainable. So, I see there are many comments now. Okay, obviously your comments are a little bit delayed. So I ask you something and I don't see your comments yet, so I must wait a little bit. Okay, solid dividend payments over time, says one. What's secure increasing dividend? Yes, for sure. and someone with a little bit more experience tells me that there is a delay between 50 and 20 seconds. Okay, thank you, really. Yes, so I think secure increasing dividend is the result, what we want to have. But if we want to find these stocks, then you don't search for the result, but you search for the underlying, which makes the result possible, probable. So there's no 100% probability. There's no safety. Corona crisis showed us, for example, stock like Walt Disney cut its dividends. And still at the beginning of the year, if you told me that Walt Disney will cut its dividends, I would shake my head or ask you, why? Are you sure? What will happen? I wouldn't have believed, but it happened. So there's no 100% safety in this world. But if we do the things right, then we get a probability as high as possible. Okay, so we need to look for stable earnings for the profits of the company, which translates into earnings and cash flows. And I will give you an idea now. I don't want to be too theoretical right now. And I will present you some pictures of a company I believe is a solid company, for example, 3M, and you will see what I mean in a second. Just look here. I will change the layout. Just look at the very first chart here, and then you see starting from 99, we even have a longer history, but it doesn't matter. I think 20 years are enough to get what I want to show you. So you see that we have here growing earnings. It's the earnings per share, growing earnings per share. Sometimes it's a little bit bumpy, but mostly you see from left down to the upper right. And because the earnings grow and the cash flows, so the real cash which goes in and out of the company is also growing, the cash which goes into the company or which stays in the company, also the free cash flow, which is the operating cash flow after the investments. This is why it's mostly a little bit lower than the operating cash flow, the free cash flow. Everything is increasing, and dividends are paid not by earnings, but by cash flow. Dividends are cash which streams out or which flows out of the company. This is why cash flows matter, because cash flows are also cash. If I report earnings, but there are no cash flows, which happens for some companies, Netflix, for example, right now, and they want to pay dividends, they don't, if I remember well, but if they wanted to pay dividends, how could they take, or where could they take the money if they have no operating cash flow, if it's even negative, because they have to pay so much money for all their film stuff and licenses and so on. Okay, so we have this free cash flow, which mostly matters for dividend payments. And then here you have the dividends, and you see that increasing dividends, they depend on increasing cash flows, which is here. And this is also, there exist two types of payout ratios. It's you can see them here in the matrix. There's one payout ratio. It's based on the earnings. It's this one. So they just take the dividend divided by the earnings per share. And this is the payout ratio based on earnings per share. And then there is another one, which is based on the free cash flow. And this might differ from the first one. You also see that it differs a little bit here. For 3M, for example, it's even a little bit lower. The payout based on the free cash flow is 60%, because the free cash flow is a little bit higher than the reported earnings. And in my point of view, this version is less known, the payout based on the free cash flow, but I think that it's the more suitable payout ratio to use. Okay, but I'm already a little bit, go full screen, resolution is low. Oh, sorry, man. I'm full screen now, and if the resolution is too low, thanks, by the way, for telling me this. Can I adjust the resolution? I hope that everything is fine now and that you see something. I can also talk a little bit more, maybe, because we are still absolutely on the basic stuff right now, and I want to to go too deep into the subjects, into the examples. So the point to stress again is that if you want to better, okay, right, thanks. If you want reliable dividend payments, if you want increasing dividend payments, then you need not to look at the dividends, especially not at the current dividend yield. That's the mistake most beginners do. They look at the current dividend yield. The higher, the better. That's what you might call the dividend trap. Other people, other dividend investors, which already went into this trap, they are a little bit more clever. They look at the dividend history. Then dividend aristocrats come into play. And that's already much better because 3M, for example, is also a dividend aristocrat. And if a company is able to increase its dividend for at least 25 years, so this company must have done something wrong, and somehow its business seems to be sustainable. And it's hard to increase dividends for at least 25 years if your cash flows and are not sustainable. There are some companies, but it doesn't mean that dividend aristocrat is a good investment, because there might be a mismatch between the dividend history and the at least most reason for the last year's evolution of the earnings and cash flows. So especially in the United States, I observed that many companies, management tries to retain its status as a dividend aristocrat. And they really fight for this status to keep it. And they pay sometimes at least dividends, even if from an economic point of view, they shouldn't, or they should already cut the dividends. And if you solely focus on dividends, you don't see this pending mismatch. Okay, got a nice comment. Well, let's look for example, AT&T. Don't be afraid if you own TNT in your portfolio. There is, I don't pretend that there will be a pending dividend cut. I just will show you that a dividend aristocrat is not a dividend aristocrat, which means it's a category, but there exist more than 100 dividend aristocrats. And there exist dividend aristocrats with lackluster profit growth, and there exist dividends with very solid profit growth. And if you only focus on dividend history, you can a little bit distinguish the profit growth, even without looking at it, by looking at the dividend growth. But it's not the best way. So this is AT&T here, what you see. And you see, mostly, if you look at the reported earnings, then you see that there is no increase at all. So basically, in 1999, last millennium, they earned 190 per share. Now they earned last 12 trading months 198. So 8 cents more per share within 20 years. That's not a lot. That's not a lot of increase. And it's very bumpy here, as you see. Anyway, it's a dividend aristocrat, so they increase dividends, but you see that the dividend increase here is very sluggish, 2 cents, 4 cents a year, basically, though not very much, because the management can't afford to increase its dividends more, because earnings and cash flows, also there are cash flows, but the cash flows, they don't really increase here. We only have here the free cash flow, and you see, luckily, that the dividends are still covered by the free cash flow. There might be even some space left for future increases, but it's a little bit better the cash flow perspective than the earnings per share perspective. but still that's not a very dynamic dividend stocks. This is a dividend stock mostly popular for dividend income investors. So if you are searching for dividend stocks, and there are people looking for dividend stocks with a high start yield, like it's the case for AT&T with more than 6% dividend yield, and there are other people which are mostly or dividend growth investors, and they look for a dynamic dividend increase. They start with a lower dividend yield, but over the years they get a higher dividend. So you can see, for example, here what I'm going to tell you. This is a dividend benchmark, and I see that the title here is not translated, but it doesn't matter in our case. So if we look at 3M, for example, that's also not very no very high dividend increase. 3M has a dividend yield of about 3.5%. I know I can't ask you for a stock because of this lagging time, but I will show you another. Tencent, for example, this is a very drastic example of a stock with a very low start dividend yield of 0.3%. So basically, most dividend investors don't recognize Tencent as a dividend stock. But if you buy the stock and keep it for about, this is only an estimate, so this is something to just to get an idea. You can't really know in advance for more than 20 years or something like that how things will go. It's just to give you an idea. But here you see that basically Tencent has the potential for you, if you buy the stock today, to give you more dividends based on your costs than AT&T within the next or after 15 years of owning the stock. Most people aren't aware of this. Okay, that's an example of which is very drastically. Let's look for another one, something in between. For example, Novo Nordisk here, and here you see that the Novo Nordisk. Let's get rid of these stocks. For example, there is a crossover in about 10 years, a little bit less than 10 years. So if you might ask yourself, should I buy 3M or should I better opt for Novo Nordisk? Then most people might opt for 3M because it gives it shines with a higher dividend yield of 3.5%. But if you opt for Novo Nordisk, then there's a crossover in 2029, and starting from this, your personal dividend yield will be higher than that of 3M, for example. So just a dividend aristocrat, this is where we came from. It doesn't say you very much. It just says that, okay, dividends so far were sustainable. But we always have to look at the cash flows, at the earnings, and this is the characteristic. This is the basic for the dividends. I think you understand what I want to say. I also told you that there exist two kinds of strategies, dividend income and dividend growth strategy, and based on what you are, your criteria differs a little bit. But I can show you how you find the most promising stocks here and how it's translated into metrics. If you, after this stream here, you start querying the web because you understood about the importance of stable, reliable earnings and cash flows, and then you want to find these stocks. And then there will be a problem because you will see that it's my own experience. Most screeners, websites, and so on, they don't give you the right metrics to find the stocks, to find stocks with stable, reliable earnings and cash flows. And this is why I created own matrix, and especially this stability matrix. So there's stability matrix. They tell you how reliable earnings increased and cash flows, operating cash flows in this case, increased. I just give you an example first. AT&T, where is it? AT&T. You see these matrix here, and then you have the stability of earnings for AT&T is 1.09. Let's have a look at the earnings once more. I shall boost my audio. I will do it. I hope it gets better now. And this matrix, it has a range from -1 to +1, with +1 being the best and -1 is the worst. +1 is like on how do you call it, a rubber, and it's just a line which goes up. It's very reliable earnings growth. It's very rare that a company has +1, but it happens that companies have +1.8 or 1.9. This case, AT&T has an earning stability of 0.2 about, which is not so well. So it says that yes, there is a tendency during the time that the earnings, the reported earnings, go up, but it's very unreliable, unstable. This is exactly what you see here. And in contrast, if we look at 3M, then you will see here that the earning stability is very high, plus 0.96, close to 1. And just to give you one more the picture, then you see compared to AT&T that this earnings stability looks much better than the earnings stability of AT&T. And so these metrics help you to find promising stocks, promising dividend stocks also. They help you to find promising stocks in general. First, it doesn't matter if these stocks pay dividends or not. It helps you finding promising stocks. Promising stocks are always, and this, it doesn't matter what kind of investing strategy you adhere. It doesn't matter. Promising stocks, if you want to buy a stock and if you want to keep this stock for several years, you always need to invest in stocks with growing profits. Profits quantified by earnings and cash flows. Otherwise, there will be no capital gains. Otherwise, there will be no dividend increases if the company pays dividends, for sure. And we have also these stability metrics, for example, here for the revenues, for the operating cash flow, here it is. And by the way, the operating cash flow stability of AT&T is much better than the earnings cash flow. So you always sometimes have to look at different metrics and not only at one matrix. So you have the revenue stability and so on. And these metrics, they help you to filter for promising stocks. So let's see how it works in action. If you hear the earning stability, at least 0.8, cash flow stability 0.8. And this is already enough to filter out many stocks, the bottom of the stocks you shouldn't be interested into. So okay, if you are looking for turnaround stocks, this kind of stuff, then you will do it a little bit differently. But if you invest in turnaround stocks, mostly you are either an advanced investor or you are speculating. Most people are speculating if they do so. And then you have here a lot of stocks. If I might ask you a question, are you interested mostly in stocks from United States only, or also in stocks from other parts of the world? Because here on Dividend Stocks Cash, we cover a little bit more than 1,000 stocks, and it's stocks from all over the world mostly. So a lot of US stocks, most stocks are from United States. This is where the music plays the loudest, but there are also stocks from Germany and Asia, other parts of Europe for sure, Russia, Australia, and so on. So I will read your answers when they come in. And what you see here basically is are promising companies because I use this quality filter. So I can just close my eyes and basically just click on any line here. Okay, I just click in any stock here. It's air products and chemicals, and then I go down, and you see that we have increasing earnings. You see that we have increasing dividends. Nice stock, huh? And then okay, let's repeat the action once again. I increase a little bit the screen now, and then click here, and it's Anthem. And then what do you see here? Increasing cash flows, increasing dividends. It's also a dividend payer. I'm lucky. I hit 2 dividend payers in a row. But it's just this what I want to show you. And basically, if you got this, then you see how easy it is to find promising companies. And now, okay, you are a dividend investors. I got one answer. Yeah, it's okay. I will come to the ranking. I just wanted to show you the importance of just these metrics here, and that with these 2 metrics alone, you can filter already for promising stocks. But that's, of course, that's not enough, because your strategy will be a dividend strategy basically, and which means that you are only interested in stocks which pay dividends. So we have these blue matrix here, and we can filter the stocks further, for example, by the dividend yield, by the current dividend yield. This is the dividend yield of the cumulated dividend yield of the last 12 months. Let it exceed 2%, maybe. And of course, many stocks go away now. And you might also say, okay, we also want to have a dynamic dividend growth last 5 years, maybe 10%. This is an annual average, 10% dividend increase. I guess it might be the increase of your wages, of your salary, hopefully. No, mostly the salaries don't increase like that. Huh? If you won't get a promotion, I think. Then you can also filter by other metrics regarding debt, regarding valuation, but let's skip this right now. And we still have some stocks. How many? 51. We have 51 stocks right now, which meet our criteria. This is already a rather demanding criteria. And we have, of course, stocks from all parts of the world, and about, if you say the 50% from the United States, I think. Okay, and now we have the next step. This screener is designed to help you finding these promising stocks. And then there's a filter first, and then there is a ranking. And you see here this column, this ranking column, and it helps you now to better get an idea if the stock suits your own investment strategy, and your own investment strategy, only you know it. So you can now adjust the ranking, and it's my personal ranking, which is profit growth. But I can also, here we have a public ranking called dividend growth. Maybe we start with this one. And then here again, we have this dividend growth, 10% for the last 5 years. This is exactly match the criteria in the filter. This is why this configuration is useless, because by definition, all stocks have 100% or have this fully reached. So we make this increase this to 25% dividend yield, maybe even better, 2.5%, or rating margin I don't need. I just use or focus mostly on the criteria I already focused on in the filter. I just maximize it. So earning stability 1, cash flow stability 1, maybe even revenue stability. The increase maybe 20%, maybe not too high, because it gets completely unrealistic. But which is not so bad. And only the points here, you will see then the score will be lower, but there will still exist a score. And I don't care about this. I don't want to make it too complicated. For the beginning, dividend growth has to go to 20% also. And then I can press the apply button here. And then you will see how this ranking, how the scores will be recalculated and changed. So I press the apply button now, take a look at what happens here. And now you see that the ranking score was adjusted according to my criteria, which matched my investment strategy. So, and then we can just sort here in descending order, which is, and then the stocks which might tempt us the most on the top. And in this case, it's interesting. It's not a US stock. US stock starts on number 4, but the first 2 stocks are from China. Then we have a stock from Norway, and then we have with Medifast, the US stock. Then we have a stock from Russia, and again a stock from Russia, and then again a stock from China, Hong Kong, exactly. So, and there maybe US investors might be surprised if they see such a result. But I think it's really interesting. And if you just a little bit, if you are from the US, just jump a little bit outside of your country, and then you will see that there are interesting stocks outside also. And I just click on the very first one, which is China Water Affairs. So it's what company? It's water utilities. So we have a 4-level hierarchy, but you only see 3 columns because the 4th isn't shown here. You can add and remove columns at your will. So I didn't show you the sector. Let's add the sector. Then you see here the sector also. And here you have the picture of China Water Affairs. If we reset the zoom, then you see that in 2003 there was they reported a loss, but it's already some time ago. But if you focus here on the later past, the last years, then you see nice increasing, at least reported earnings, while the cash flows go a little bit up and down. What's interesting also is here, this is another view. This is the earnings per share view, and this is the view of on the company level, but not from the profits, not from earnings and cash flows, but from the source of cash flows and earnings, let's say revenues and margins. Revenues and margins are the ingredients for the earnings and for the cash flows. And what you see here for the stock looks really, really promising. You see first, margins were a little bit were negative. So this is why the company posted losses, and they had revenues which were very, very low, flat, even declining. But then in 2007, then there was a turnaround, and since then the revenues increased dramatically from 140 million Hong Kong dollar to more than 8.5 billion Hong Kong dollar within 12 years. So this is really a lot. Why Hong Kong dollar? Why not US dollar or euro? On this website, on Dividend Stocks Cash, we always try to analyze the stock in its home currency to avoid currency or exchange rate fluctuations. So we want to get a better picture this way from how the company is doing. And you see that the company is doing fine here. The revenues, they match the earnings very closely. They match the earnings very closely because starting from 2008, the revenues are very stable, which means that every increase in revenues will translate in increases in earnings the same way, on the same level, basically. It's another question about the cash flows. So you see the cash flows, they don't really translate. We start here in 2003, and here also 2000. Here you see they go up and down. This can have different causes or reasons. There might be a delay in payments, for example, or any other reasons. I don't know, but this would be a deep dive into the company's cash flow statement, and I want to do that. I don't want to do that right now. It's still a high level. I just wanted to show you here that we have promising dividend stocks, and the most promising dividend stocks on the top based on our filter and our ranking. Now you might say, okay, but China is not what I want because of human rights and because I don't trust yellow people or whatever reason you have. Or so let's say you can filter by country and then go for the United States only, and then you still have 28 stocks from the United States, and you still have here Medifast, Extra Space Storage, Home Depot. Some names are very well known, I think. Lockheed Martin, Texas Roadhouse, Cisco Systems, Illinois Toolworks, BlackRock, Union Pacific, many big names of many big companies. Here you see the market capitalization, often even more than 100 billion, but there are also smaller companies. Medifast is a company with a very low market capitalization, so you might not know it. Maybe, I don't know if you know it. So they started paying dividends in 2015, just about 5 years ago. But you see that they have a nice increase of earnings, cash flows. Yes, and finally dividends as well. Here a little bit stagnation, but now it seems to take really off here. It's always interesting if you look at such stocks and if you discover such stocks, what happened here, for example, because revenues decreased and it go one more down. And then here you see that the balance sheet deflated. So, which means that maybe there was a spin-off or there was a divestment, something like that they wanted to focus on the core strengths and so on. We can find it out, but not right now. We will do maybe some more deeper analysis of some stocks later time. So I think these might be really stocks which could be interesting if for sure the filter criteria and the ranking criteria match your personal investment strategy. Then you see here the dividend yields. They start from with 2%. We filtered for stocks paying dividends more than 2%. If you sort another way, then we have even dividends starting from 4%. And Extra Space Storage, for example, like public storage, is a storage REIT, 3.5%. And this is maybe the last stock I show you. We already have 40 minutes here. So this is the last stock I show you. And then you see it's a REIT. It's a REIT, and REIT is evaluated by funds for operations. It also has earnings per share, but earnings per share are misguiding in this way. So that's why we take funds from operations, because the earnings are mostly too low for REITs because of amortization and demortization for all these buildings and so on they have. Okay, here in this case, it will be containers mostly, but the funds from operations are more suited to evaluate a REIT. And you also see that the dividends mostly are much close to the funds for operations than they are for earnings. Here it's not so obvious, but for other REITs like I think Realty Income and so on, you see it better. So you see it's a very, well, I think it's a very nice stock. Also here, during the financial crisis, there was a dividend cut, which is not so nice. But since then, we have increasing, growing business. And then starting in 2080, maybe there's a kind of saturation on the storage container market. So the increases are going down. And probably this is why we have a dividend yield of 3.5%. Now, you always often have this observation that when the increase goes down, the yield goes up, which is a normal reaction of the market, because if the outlook of the company is not so great anymore, because the profit increase goes down, then the stock price goes down. The dividends either remain flat in the worst case, but mostly they still go up, maybe also a little bit more slower, but they still go up. And the dividend yield, because of the sinking or declining stock price, really goes up like a rocket. Let's see it here. No, here we can't see it so good. Let's have a look here, just for the last years. This is the financial crisis. If you look here, then you see this is the historic dividend yield, and then you see that the dividend yield is now 3.5%, and it's at least much higher than from 2011 to 2013. And my guess is, when we will see it immediately, that this is the time frame when there was nice earnings increase. So let's go back here, and then you see this is exactly, or the funds from operations increase. Here the dividend yield was very low because we had nice growth here. And then we have nice growth once again, 2016, 2017. Let's look if you can see it here, yes. And then you see that, and then it goes up. It goes up because we see here a little phase of stagnation mostly. And then earnings recover here. Earnings growth recovers, I'm sorry. And then you see earnings growth recovers, and mostly the stock price goes up, dividend yield goes down. No? It's basically always the same game. And I think it's important to understand this little game. Okay, I'll look if there are any questions. There are none. We have about 45 minutes. I think I will stop right now. I see that I have 5 viewers. Thanks for anyone watching so far. I'm really happy. I will try to continue this, make maybe a little series out of that, and then also show you first, give you basics about investing, and then second, show you a little bit how this screener works. Okay, thank you too. See you next time. Thanks for watching. Bye bye.